What if your vacation home could unlock a six-figure tax deduction this year?
Essentially, that's what we're doing. We are giving people these expenses up front so that they can negate their income, their cash flow, their taxable income, lower it, and pay little to no taxes.
It's not a loophole, it's the tax code. And if you're in short-term rentals, it's time you learned how to use it.
Right, when they're looking at how profitable you are, or if they're qualifying you for a loan. But from a tax perspective, you're allowed to use that wear and tear expense of $10,000 every single year to lower your taxable income.
We're speaking with Sean Graham, who's helped everyday hosts legally defer hundreds of thousands in taxes without needing to go full-time real estate pro.
Like an investing standpoint, your goal, right, is to pay as little taxes as possible, is to continue to keep the money, keep the cash flow, keep reinvesting in real estate, keep playing the game.
I'm 31-time Airbnb superhost Jason Muth. I worked in the media business for over 25 years. In 2016, we purchased our first short-term rental, and that is now our chapter 2 in life. Since then, we've welcomed over 5,000 guests and their furry friends to our homes. And now we're here to show you how to create a smart stay. Now, on with the show. All right, a big welcome to Sean Graham, who's a real estate investor and an expert in cost segregation studies and tax strategies for short-term rental people. And normally we would think this is kind of like a dull, boring conversation because people think about short-term rentals and they think about hosting guests and designing spaces and having fabulous houses. But this is probably more important than any of that stuff because cost segregation can save you a lot of money, as it did with us. So Sean, welcome to the show.
Yeah, thanks, Jason. Thanks, Rory, for having me. I appreciate it. I'm glad to be here.
And Rory and I were just kind of talking off camera also about how we've become, much more versed in cost segregation studies over the past couple of years, having done 2. Is that right? We've done 2 ourselves.
We've done 2 of them. And, for those listening who are trying to make sense of why this is important, just imagine if you could write off a large chunk of the purchase price of your short-term rental in the very first tax year. What would that do for your tax liability? Now, it's a little more complicated than that. There are a couple other things that you have to jump through. But what if you really could take an enormous tax deduction the year that you got your short-term rental?
Yeah.
Yep.
Just a quick little background, Sean, we, you and I were just talking also, and we learned about cost segregation at Bigger Pockets conference back in 2022. I mean, we followed the podcast and we'd heard about it prior to then, but, I saw them speak about it at a tax strategy panel. And I actually was texting Rory from the panel and I'm like, Rory, why aren't we doing this? And I think we should be doing this. And that was was it the last 100% bonus year back in 2022? Do you remember the schedule?
That was our last. That was the last year that we could do 100%.
Yes, but it still does not mean that you shouldn't be doing these, and we'll learn a lot more about why. Right. So Sean, first let's Sean, you're out in Detroit, Michigan.
I'm in Detroit.
City.
Yep.
Yes, excellent. What got you into understanding this space, into cost segregation studies? You are a CPA and investor yourself, but how did you specialize in this?
Yeah, that's a good question. So I started off my career in accounting and as a CPA in public accounting, doing a lot of tax. I went down the corporate route, worked in different roles in accounting and finance. But I really did it because I wanted to understand the language of business, meaning like I wanted to understand financials. I always wanted to be an entrepreneur. I figured if I had that foundation, then that would allow me to go do anything else. So I didn't really see my career coming back to accounting or finance. I saw it more as like a foundation, a tool to go out and do my own thing. So at a certain point in time, I went into real estate full time. I went into real estate. I was investing in small residential duplexes, triplexes, things like that, but along with self-storage facilities. So I still have a real estate portfolio. I still have long-term rentals, a short-term rental, self-storage facilities. But being on the other side, being on the investing side, I saw the gap there, and I saw a way to bridge both worlds. My background in tax, along with being a real estate investor, because I get it from like an investing standpoint. Your goal, right, is to pay as little taxes as possible, is to continue to keep the money, keep the cash flow, keep reinvesting in real estate, keep playing the game. And from the IRS standpoint, that's what they want you to do. They set it up that way. So they want you to keep playing the game. They incentivize you to keep reinvesting in real estate, right? So I'm able to understand it from both perspectives. And I think that makes my position a little bit unique. But we are aggressive with our cost segregation studies, but we stay within the rules and within the limits, right? We're not pushing things way outside the norm where, hey, you're going to get flagged, you're going to get audited, anything like that. And we do the work correctly and by the guidelines to have it backed up. So I saw that as an opportunity. I think there's, I know you guys focus on short-term rentals quite a bit, but there's a kind of a gap where that market isn't focused on as much. Like a lot of people are really focused, or cost segregation firms are really focused on like big commercial real estate, which we do, but we try to like really focus on that middle ground there too, with short-term rentals, residential real estate, that sort of thing.
So let's talk about something that you just mentioned about how the IRS encourages us and wants us to do cost segregation studies, which sounds so counterintuitive, because we all think of the IRS as, collecting our taxes and maybe giving us a refund if, the majority of people are W-2 employees and, maybe they like tax season because they get that big chunk back. When you're a real estate investor, you're really looking to defer or offset your taxes as much as possible. But why does the IRS want us to reinvest as real estate investors? And why do they give us these tools to be able to do it?
Yeah, that's a great question. I would say my opinion on that is because real estate is really the backbone of the economy. You have small businesses that are built on real estate. That's where people live, right? Everybody needs housing. They need places to live. And the government or the IRS, they want you to continue to invest in real estate and to help build the economy. So real estate from, a foundational standpoint is like super, super important to the country. So they give you incentives to continue to invest in real estate. And like you said, it's not we avoid taxes. It's a tax deferral strategy. Now, there's ways to eventually keep kicking the can down the road where you end up not having to pay those taxes at all. And we can get into all of that. But overall, the IRS, they, really, really likes real estate and they want the economy to keep growing.
Yeah. On a very simplistic standpoint, like what I learned is that real estate investors want the money now, not later, whatever that means. Right. And then they want to kick the can. So they're deferring taxes as much as possible. And ideally, you're passing this on to your heirs. So you're stepping up the basis of the property when your heir, inherits the property, which then would offset a lot of those gains. And that it's not as simple as that. There's a lot more complexity, but that's our strategy. That's what we're doing. That's what a lot of people are doing right now, where we keep reinvesting in our properties, using the tax code to our advantage legally. And then hopefully we'll be able to pass these things on to our daughter, and she won't have to pay tax upon that inheritance. But, that a lot can change between now and when we do that. Let's really start with cost segregation, right? Like,
sure.
First of all, when you're up at the lake and you're playing cornhole with your friends and they say, what do you do? And you're like, I'm an expert in cost segregation and I'm a CPA. And they're like, what is that? Like what's the 2-line sentence that explains what cost segregation is?
That's so funny. I mean, the conversation quickly shifts if they're not a real estate investor. They kind of nod, say that's cool, and we go on with the game of cornhole, right? But okay, so how I'd explain it, like just a quick overview. Somebody who's not familiar is essentially I help real estate investors save on taxes. Help them pay little to no taxes through what I call cost segregation. To take that further, right? Seeing that like if that's an acceptable answer, to dive like another step further would be the IRS requires you to depreciate real estate. So if you don't do a cost segregation study, you either depreciate it over 27 and a half years for residential, or you do it over 39 years for non-residential or like large commercial, right? That's great. But if you do a cost segregation study, you don't have to wait 30 or 40 years to get all of those benefits. We front load the depreciation into the first year, like with bonus depreciation, but we move a lot of it into 5-year, 15-year, 7-year life. And so you get these benefits up front. So the question is, if I said, hey, Rory or Jason, if I gave you $1 today or $1 in 30 or 40 years, which one would you rather have? You'd say, well, I'd rather have the dollar today, right? $1 in 30 or 40 years is not worth nearly as much as $1 today, just time value of money. And essentially, that's what we're doing. We are giving people these expenses up front so that they can negate their income, their cash flow, their taxable income, lower it, and pay little to no taxes. Now, like you said, it's a deferral. It's a tax deferral. Meaning the IRS wants you to pay taxes. Your tax bill is due. So either you can pay it now or you can pay it down the road, right? Or potentially, if you play the game right, you might not ever have to pay those taxes. So you'll continue to see, like you mentioned, right? Like with your daughter, you want to keep kicking the can down the road, and eventually she inherits the property. She doesn't have to pay. She doesn't have to pay those taxes that you deferred because she gets a step up in basis. So what that means is that if you keep buying real estate and you either 1031 exchange into the next property, or even if you don't 1031 exchange, let's just say you keep buying more and more real estate. So whenever you do sell a property and you have to pay back the depreciation recapture, well, you have another property over on the side, which also has depreciation, which can offset that recapture, right? And so you keep buying more and more real estate. And then eventually, whoever inherits the property, your heirs inherit the property, they inherit it. Their basis is whatever the value is when they inherit it. So if you bought a property for $200,000 and then your daughter inherits it at $1 million, right? Well, she doesn't have to pay taxes on the $800,000 in capital gains. Her basis is $1 million. So if she doesn't want to hold on to it and she sells it like a year later at 1.1 million, well, that $100,000 difference, that's what she would have to pay capital gains on, not the $900,000 difference. So that's the beauty of real estate. That's why you see a lot of, families, wealthy families invest in real estate, right? Even if it's not how they made their money. Some of them did make their money in real estate, but a lot of them, it's a good family, like tax planning strategy is to, own and invest in real estate.
Whenever I've explained cost segregation and the benefits of to somebody, I feel like I have to break it down into a couple separate concepts: the cost segregation, bonus depreciation, and then just depreciation as a whole. But there was a time before we even had bonus depreciation, and cost segregation still existed for properties, where for most residential properties, you would have just taken the land and set that aside.
Yep.
Because land's not depreciable, and the rest of the value you'd just depreciate over, in that case, 27 and a half years. Other properties you depreciate over 30, 39 years. But even then, larger properties, before we had bonus depreciation and people were allowed to kind of accelerate the depreciation to the first year, they would break things down into 5-year, 15-year, and other categories, and actually do that cost segregation. So let's just go back to that world for a second and explain what the cost segregation study looks like then and why that's a benefit. And then we'll jump ahead to incorporating the whole bonus depreciation and why it's really become popular in the residential space.
Sure. So, okay, I'll try to touch on those points here. So, when I said the IRS, they require you to depreciate the property, the default method is straight line depreciation. So let's just say you have a $300,000 property, okay, and land, like you mentioned, Rory, is not depreciable. So we'd remove the land value. Let's just say it's $25,000, just for simplicity's sake. So you have this $275,000 property. Well, with a residential, like long-term real estate, you take that property and you depreciate it over 27 and a half years, which means you get a $10,000 write-off every single year. So, like, why? What is depreciation? Depreciation really it's just the IRS saying, okay, you owned a property. There's going to be wear and tear, right? And over time, the value is going to depreciate because, you'll have to, the roof will wear out, the brick will, get worn down, whatever it is, there's wear and tear on the property. And so we're going to allow you to take this phantom expense and use it as an expense on your taxes every single year. Cool thing is that as a real estate investor, like you want to pay as little tax as possible, but you also want to show that you're profitable. So from a lending standpoint, the lenders know that depreciation isn't a cash flow expense. It's not that $10,000 is actually coming out of your bank account. It's that this is depreciation. And so they add that back, right, when they're looking at how profitable you are, or if they're qualifying you for a loan. But from a tax perspective, you're allowed to use that wear and tear expense of $10,000 every single year to lower your taxable income. So essentially, that's what depreciation is. Now, a cost segregation study it's a engineering study that what we do is we go into a building, or we look at a building or a piece of real estate, and we say, hey, IRS, like, not everything is going to take 27 and a half years to depreciate. In fact, a lot of it could be depreciated over 15 years, like everything outside, let's say land improvements. So we're talking about landscaping, fencing, let's say outdoor lighting, things that are not part of the building, but they're man-made, right? It's not dirt. Stuff is the driveways, the sidewalk. That's 15-year life. Then for like short-term rentals, you have furniture, right? So furniture, that would go down to 7-year life. Then you have a 5-year life, which is stuff inside the building, but it's non-structural components. So stuff that it's more non-permanent and can be easily removed. So let's say you have fancy lighting. A big one is laminate flooring, certain types of carpeting, things like that, right? So more non-structural or non-permanent items inside the house. Those are 5-year life. Now, everything that's less than 20 years is eligible for bonus depreciation. So bonus depreciation is what you hear about where it's, hey, I can just expense it all out in year one, right? That was 100% bonus depreciation. Now that's phased out year by year. That was end of 2017 through 2022 was 100% bonus depreciation. So that meant anything that you recategorized from 27 and a half or 39-year life down to a shorter lifespan, you could just write it all off in year one, which is a really big deal, right? Like if you have $1 million property or basis and you're able to recategorize 20,000 or 20%, $200,000 into a shorter lifespan, well, you could just take a $200,000 phantom expense on your taxes. It helps a lot, right? So bonus depreciation has been phasing out every single year for the past few years. So it goes down by 20% each year. So for 2025, it is 40%, meaning like if you have $100,000 that you move into 5-year life, well, you could take 40,000 in year one, and the remaining 60,000 would have to be depreciated over those 5 years. That could come back. We'll see what legislation does. Like there's a good chance that changes here in the near future. Then it goes back to 100%. But regardless, you are recategorizing from a super long time, like, long depreciation schedule into a shorter depreciation schedule.
Yeah, last year it was all the rave to be talking about 100% bonus depreciation coming back, and it never quite happened. So here we are, with the phase out. If the phase out happens on schedule, in 2026 it'll be 20%, right? And then 2027 would be 0. It would just be back to the standard depreciation schedule, but you could still pull forward all those elements that you just mentioned, the blinds, the countertops, the laminate flooring, the pavement outside, and you're not going to depreciate it over a 27 and a half year life, or what is commercial, 39?
39, yes.
39, yeah. You're still going to pull it forward into, 5, 7, 15. I think those are the schedules. So, for 5 years, $100,000 expense with 0 bonus depreciation, that's still $20,000 per year for 5 years. Did I do that right?
Yes, I think so. Yeah.
All right. Look at that math. So regardless of if the bonus depreciation is here or not, it's still a good idea to do these cost segregation studies if you're really looking to maximize your tax liability and optimize that and reinvest in your business. I do remember, the last year of 100%, Rory. That is when we bought our last investment, right? Actually, no, we put one in service that year too, right? Remind me.
Yeah. So our cost segregation studies, one was for the year 2021. That was the year that we did an amended tax return to take advantage of it, which took 16 months for the IRS to process. And then the following year is when we did a cost segregation study at the full 100% for a newly acquired property. And then for the property we built, we did not do a formal cost segregation study because we could actually calculate based on our own records, how much the land cost, how much the different components of the house cost when the developer went through and built it, because we were there for the building.
Got it.
Right. Yeah. So that difference, like the property that we bought in 2022, it was a $900,000 purchase that we were able to pull forward a few $100,000 of bonus depreciation, based on the elements of that property. And, with I'd love to hear about your method of how you do it. And you mentioned engineering study. I understand that back in the day, you used to have to go on site and you're measuring things, and, it's very meticulous. And we worked with a company that, we did a video walkthrough of the property, that was a good hour that they, studied afterward. And then magically a couple weeks later, I'm sent this 40 or 50 page document of a study, basically that, pulls apart the elements of the property and gives a dollar figure to everything. And to my understanding, we just have that here. We don't submit that to the IRS. We've never submitted that to the IRS. Hopefully we're never going to have to submit it to the IRS, but if they come knocking, we'll have that document to say, well, here's the work that we did. Talk about your process and how, you're working with Maven Cost Segregation and how you work with your clients.
Yeah, no, you nailed it. So we do detailed engineering work, which means that we are actually looking at your specific building and breaking down the components within that building or that property. And we're doing it on a detailed engineering basis. Now, we have two different options. We have just a full detailed engineering study, which is the most common one, right? And that's sending somebody on site to take pictures. We can do it remotely, but honestly, a lot of times it's almost easier just to have somebody go on site and take pictures. But we can do a video walkthrough as well if that's a better option. But we get these pictures taken, and then we're going to collect all the information from you. So we're going to collect closing statement. We're going to collect ways to help you get a land value. So we're going to look at the appraisals. We're going to look at property tax assessment records. We're going to look into credits. Are there seller's credits? Does that affect the basis? Things like that, right? And our in-house engineers are going to break down all of these components. So we use an IRS approved method we use something called RS means, right? And RS means allows us to really assign pricing, and we get the quantities and the measurements, and right, they're estimates. We're not going to go in and measure every single little thing within the property, but we have a pretty good idea, from a high level. You can do a lot of this with softwares and stuff online. We can get measurements of what approximately how much of it is vinyl plank flooring, right? And then we're able to assign pricing components based on your specific location and when you purchase the property, a price to that. And so we break down all of the prices. The idea is to get all the components within the property and assign them correct pricing allocations. And this allows us to break these things down into the different lifespan categories. So that's what we're doing. The second option, we do a condensed version, which is just a little bit more streamlined. It's still detailed engineering, but it's better for small residential properties. So let's just say you have a long-term rental, you bought it, it's a few $100,000, and it doesn't quite make sense to pay $3,000, $4,000, $5,000 for a full detailed engineering study. Well, we will do those, but we're going to rely on you to take the pictures rather than sending somebody on site. And we're not going to do a full narrative. We're not going to do a 50-page narrative. We're just going to do the detailed engineering work, which that's better, again, for small residential properties. And we can do that. It's a little more streamlined. It makes it where it's affordable from a return on investment standpoint from the investor, and allows us to save on certain costs and pass them along to you as well. So those are the two different types of studies that we do. We do a lot of, long-term rentals. We do a lot of short-term rentals as well, which, I think we could dive into as well when you guys want, because the benefits of short-term rentals are crazy, especially for people who are high income earners and they're not in real estate full time. But yeah, that's
Yeah.
a process overall.
Talk more about that.
Yeah.
Why would somebody, the individual investor who maybe is looking to buy their first short-term rental or has one property, why should they do a cost segregation study? Let's say that they are working a W-2 job and this is, their lake home that they purchased to use with their family and make some money on the side with Airbnb.
Yeah. So let's break this down. So are you guys you're in real estate full time? Is that correct?
Yeah, we are. So we file as real estate professionals and have for a while. So
Okay.
we've had that benefit as well.
Yeah. So the IRS looks at real estate as a passive activity in general, right? So they say, hey, this is passive income. Like real estate is just deemed passive income. So what that means is that passive losses, such as depreciation from a cost segregation study, can only offset passive income. So you have a long-term rental. Let's just say you rent it out, it cash flows. You're paying down the principal, which counts towards your tax, your income as well. The principal payments do, because that's not an expense. That's building equity. And straight line depreciation isn't covering enough it doesn't give you enough depreciation to offset all of your rental income. So you do a cost, which is typically the case. You do a cost segregation study and you're able to offset all of that taxable income now. Okay, so that's one way to do it. Now let's say you are a real estate professional, as you both are real estate professionals, right? So that means that you do real estate more than you're doing anything else, and you're spending the time in your portfolio. It's at least a minimum of 750 hours. It's real estate related. It's not like searching for properties, but it's more on your portfolio and towards your own work, right? And so that means that, well, okay, real estate really isn't passive for you. Like this is an active thing. This is a full-time thing for you. And so the IRS deems that as active, and they allow these losses now to become active too, which means that, let's say you do have a part-time W-2 job, or someone's married, they have a spouse who has a W-2 job. Well, you can use the depreciation losses, because you're a real estate professional, as active losses. Then not only can it offset the real estate income, but it can also move over and offset active income, such as W-2 income or even portfolio income, right? So that's a beautiful thing. The other thing is, though, like, you have high income earners who they're not real estate professionals, and they want the depreciation benefits. And so you'll see a lot of them go into short-term rentals for a very specific reason. Yes, short-term rentals are fun. There's a lot to it, but also the IRS looks, if you meet certain requirements, it's commonly referred to as the short-term rental loophole or short-term rental strategy. They say, well, this is an active business. This isn't actually passive. So it's almost looked at as non-residential. So what that means is that you have an average rental period of 7 days or less, and you're not using it as your primary residence, right? And you materially participate, which means that you spend at least 100 hours on the property and more than anyone else, right? Then you're materially participating in that property. And so now the IRS says, well, this is an active business. And so these losses are also active and can offset W-2 income or active income. So you'll see high income earners. Like we work with like a lot of doctors who, either the doctor or the spouse will manage and be materially participate in the short-term rental, and they'll get cost segregation studies done, and the depreciation from those will help offset the income that they're earning in their regular job.
Okay, so follow-up question to that. So I'm wearing a Pride Away Stays sweatshirt if you're watching this on YouTube. And that is our co-hosting business in Provincetown, Massachusetts, which is separate from the properties that we own. But we just built that up over the past year. We actually have some clients that kind of fit that criteria where they're working W-2 jobs, and they asked us to be their co-host. But I've had questions from them about, hours worked on the property because they're trying to optimize it for their own return. How does somebody hire a co-host like us? Like, okay, so, person X and their spouse, they live in the city, they're super busy, they have families, they don't have time for short-term rental, but they want to take advantage of some of these benefits. So they buy a short-term rental and now they got to learn how to run it and they don't want to. So then they bring us in. Where along the way do you think that person might be able to utilize a strategy such as a cost segregation?
Yeah, so that's a good one. I think this is often a common issue. So there are, let's see here, I haven't pulled up. There's 7 material participation tests. Okay, um, and the idea is that one is like, okay, you spend 500 hours. So if you spend 500 hours, then you're good. You're able to claim material participation in that property. So even if you have a third party manager, right? Now, sometimes if people buy a property, they rehab the property, they put in all the work, it's a big project. Well, you're putting in that 500 hours. So you're going to be able to claim that material participation. Now, a lot of people are not able to do that, right? And so it comes down to this. There's another rule, and it's you participated in it for at least 100 hours, but also more than anyone else, more than any other individual, right? And so I'll emphasize the word individual. And so what that would mean is that, let's just say you have a short-term rental. Okay, well, you need to be materially participating in that, even if you have a third-party manager. But I think from a backup perspective, it's like with a third-party manager, well, can you break like the hours you are spending? Can you kind of break that down by an individual? And so it's more work on your standpoint, right? As the third-party manager, but you want to ensure that the host, like the owner, right, is able to meet those 100 hours and is more than anyone else. So if you have the same person cleaning the property every single week, well, that person might be more than 100 hours, right? But let's just say that you use 5 different cleaning services and you rotate them, right? And you rotate them around. Okay, well then maybe you have 5 different ones and they're all at 20 hours a piece. And so it's not as big of a deal. Or maybe it's just 2 and they're both at 50 hours a piece, whatever that is. So it does come down to being able to prove that you worked on it more than anyone else. So I would say that it's okay to have a third party manager, but you want to stay involved in the property. If you're going to like turn this over to third party manager simply as like this is a passive activity and I'm not involved, well then you're really going to be stretching the limits to say like that you are materially participating in it. Does that make sense?
Yeah. So the moral of the story is, like, on behalf of our client, we should have a different cleaner every week for them.
Yeah, and so this is I guess I'll say this is my take on it, because the word is individual more than any other individual, right? So, I mean, if you're able to kind of log that, but at the end of the day, right, the owner has to prove that they put in those hours too. So, what is the owner able to do? Let's say if you do have a third party manager, well, what is the owner doing, or what did the owner do originally to set that up? Like, you want them, if this is important to them, the short-term rental loophole, and they want to be able to claim material participation so that they can continue to, use these depreciation benefits, then you want to make sure that they are involved and they understand these rules to some degree.
Yeah, and to an extent, it's on them. I mean, like, if they've hired us, we just do our job, and then however they're going to calculate
Right.
that in the eyes of the IRS is going to be on them.
Yeah, I wouldn't worry about it too much. I think exactly. I wouldn't worry about it too much. I think it's more, do they want to materially participate on it or not? If they do go to you, right, and they talk about that, they want the best of both worlds. Well, then I think it's something that you guys just need to strategize together on.
Yeah, because it is our one of our hypotheses with Pride Away Stays was that it was a company. We work with mostly owners that own their properties and use them. A handful of owners are just pure investors, But Provincetown is not really the type of market where you're going to invest in it and be absentee. You probably have a connection to the market for whatever reason. You've been vacationing there forever. You love going there with your friends, and you always wanted to own a piece of it. So,
Yep.
I know there's a lot of people that we work with that are still busy professionals. And I wonder if this is an opportunity for us to, present this as an idea to them. Because a lot of those folks, I'm guessing, are not thinking cost segregation. Like, this has not come up with a lot of clients. A lot of clients just are buying a second home and they're in sticker shock as to what they just paid.
Yeah. Yeah.
Yeah. Hey, Rory, any final questions for Sean as we wrap up?
I mean, we talked about kind of the benefits of doing a cost segregation study, how it interacts with bonus depreciation and even real estate professional status.
Yeah.
But is there anybody who shouldn't be doing a cost segregation study for, certain kinds of investments, certain kind of people where it's just not worth doing?
Yeah, for sure. I think if you really understand the rules, there's a lot of ways to have depreciation benefit you, right? But let's just say you have a rental property and straight line depreciation is covering enough of it. You're not a real estate professional, right? You're not doing short-term rental loophole, and you just have a rental property on the side, but you work full time. Well, if straight line depreciation is covering enough and it's offsetting that profit, well, then you're probably good. You don't need to go do a cost segregation study and like get all this extra depreciation. There's not a need for it if you don't need it, right? So like, moral of the story is don't go get a lot of extra depreciation if you don't plan to utilize it or you don't plan to need it. Now, one thing I would say to keep in mind is that when you set, even if you are that person, you're not a real estate professional, it's not short-term rental loophole, but you're building up a rental portfolio. If you go sell one property, then you have to pay capital gains tax. So a cost segregation from property B that creates a lot of like front-loaded depreciation can offset the capital gains from the sale of property A. So that's often referred to as a lazy 1031 exchange. So that's something to keep in mind if you plan to keep playing the game, keep investing in real estate and building a portfolio, like it still is beneficial from that way. But if that's not what you're doing and you just have rental property and it's not cash flowing well, it's not very profitable, you probably don't need a cost segregation study to offset it. So I think it comes down to speaking with your tax CPA or looking at your taxes and seeing basically is this rental property increasing your taxable income or not? Because if you're in the 25% bracket, well then and you make $10,000 of rental income, well, you're paying $2,500 of taxes on that, right? At 25%. So it's really, you have to look at your taxes, talk to your CPA, see if you have enough depreciation to offset those things. And a lot of times you're not, but if you have a property that's not performing well, then probably don't need to get a cost segregation study for it.
We appreciate this discussion, and I think that if people are looking to get into the short-term rental world, which you probably are, or you're in it already if you're listening to this podcast, and you haven't taken advantage of tax strategies such as this could be a hidden pocket of money for you where you could then reinvest in your current property or future properties. And, my hunch is a lot of people are unfamiliar with this strategy. So, don't feel ashamed if this is all an education to you. And if you're very familiar with it and this was just a reassurance that you're doing the right thing, then, bravo, right? But, cost segregation and tax planning is a key component in the world of short-term rentals, especially if you're working full time. And, it's experts like Sean that can help you maximize your tax strategy, by really showing you what depreciation you might be able to take in your property and use that to your advantage. Sean, we'll link up mavencostseg.com in the show notes here. And I know that you're on LinkedIn as well. So I'm sure people could reach out to you in those manners.
Yeah,
Go right
absolutely.
ahead.
No, and I was going to say, look, it doesn't cost anything to get an estimate on your property. So if you come to us and you submit your information or give us your details, the purchase price, the address, that sort of thing, we can see some pictures. We're going to be able to give you an estimate, free estimate of benefits on how much depreciation you would expect every single year in the depreciation schedule. So that's super beneficial. I also, Rory and Jason, if it's okay, I created a link for you guys if you want to add it to your show notes. If they go to mavencostseg.com/smartstay, then I'll put a discount on there for the listeners too if they want to go ahead and get a cost segregation study done or just want to look into it.
Excellent. Well, pulling forward tax money, and we're also getting a discount off of the study itself. So thank you. We appreciate that, Sean. Rory will link up your website as well. If you need legal advice here in Massachusetts or New Hampshire, it's str.legal, right?
That's right.
All right. And if you've enjoyed this episode and want to be a guest on the show, you can go to smarttodayshow.com for all of our episodes and for our form that you can fill out. Let us know who you are and what you want to talk about. Sean, Rory, thank you so much for the discussion. Thank you for making tax planning not boring and interesting because people love saving money. So, I find this to be fascinating, and hopefully you as a listener have as well.
Yeah. Thanks for having me on.
Our pleasure. And we'll see you next time.